Yeah, good day everyone, and welcome to this tutorial class. My name is Pastor Unam Oluwashino. I want to use this medium to appreciate God for this grace given to me to speak to great people on this platform, and I want to also appreciate Pastor Dr. Mike Igbailo for this session and the opportunity to make this presentation to you people. I went through the material for the class and there were like 50 something slides in the material. And after going through, as in considering the time frame and then the urgent urgent need for this tutorial, Pastor Mike, Pastor Dr. Mike and I discussed that we should work with the assignment given to you so that through that assignment I explain some concepts and then we also solve them together. So I'm going to do this right now through this video. You listen to this video and then when we meet in class on Friday by between the hours of 7 and 9 p.m., we can ask some more questions and then we give answers to those questions so that all of us can move on. So, and if you don't have any question, we meet in the class. It's okay, I'm fine. To also reduce meeting time for the day. Okay, let's go through the slides one by each. I have like 11 slides here to present to us quickly. Thank you so much for your time and God bless you. Okay, let's move on. The first slide is talking about the timing of financial statements. And then the question is indicate whether each financial statement reports amount over a period of time or at a point in time. When we are talking about presentation of financial statements, we financial statements include the balance sheet, the income statement, and then statement of cash flows. These are the three statements considered under this question to determine the timing. Is it over a period of time or at a point in time? Now, when we follow the periodicity concept of accounting, we and the entity concept, when preparing a financial statement, it is advisable that you write the name of the person you are preparing the account for and then the period at which you are preparing the account, whether it's for the period or as at the period, as at a period or for over a period. So in the income statement and sale of cash flows, the income statement comprises the income and expenditure of the of an organization using the accrual and matching concepts, while the statement of cash flows is represented by only the cash flows, transaction that has to do with actual cash flows, cash inflows and outflows to show the liquidity of the organization and how the organization manage its liquid assets. So when you are preparing both accounts, we prepare them over a period of time. A period of time here means like 12 months. It can be termly, it can be monthly as the request is needed and the urgency of the information needed. But normally, accounting financial statement can be assumed to prepare over a period of over 12 months, excuse me, which is a year. Now, the income statement and the cash flow statement are prepared over a period of time. The transactions there are not transactions for just a period, they are transactions over periods of time. So the periods of time come together, reported in 1 year is over a period of time. But the balance sheet, the balance sheet is not an account, but a statement that shows the financial position of the organization. That one is prepared as at a point in time, as at December, as at as at December as at based on the accounting period of the organization. So in this question now, the balance sheet is at a point in time, income statement is over a period of time, and statement of cash flows over a period of time. Don't know if there is any question. You can write down your question and then ask for more clarification on this timing and then the financial statement. Let's move to the next slide. This is talking about accounting measurement, and then when we talk about the measurement convention of accounting, accountants look at how do we measure our assets and liabilities in an organization. How are they measured? Is it at cost, at market value, at net realizable value, at present value, or at what? So the value at which the value that the accounting items carry in the financial position of the organization follows the measurement convention of accounting, and there are different accounting measures to different items and values in the organization and in accounting. Take for instance, when we look at the inventory and account receivable. Inventory is talking about the stocks or the goods, the stocks, and then account receivable is talking about your debtors. Now, before you can present the amount of your debtors in the balance sheet, you need to measure it. You need to make provision for loss. So it is either you measure it at a cost or at a net realizable value, whichever is lower, because in accounting we make provision for loss. So if the cost of the account receivable is lower to its net realizable value, you use the cost. But if the net realizable value is lower to the cost, then you present it using the net realizable value. Take for instance, in the receivables, it's possible that we have bad debt, provision for bad debt, provision for discounts allowed. Now, when these provisions are there, you definitely reduce them from the actual cost of the receivables of the debtors, and then by so doing, the account receivable is measured using the net realizable value. So also is inventory. If there are some uh, some valuations that you need to make to reduce your inventory using the accounting valuation methods, then you present it at the lower of the cost and the net realizable value. So that is the way we measure inventory and account receivables. I want to talk about land. Land is measured at historical cost. Historical cost means the cost and other incidental costs that were incurred in buying the land, like the real cost of the land, the incidental costs in securing the land, all are matched together to form the amount, the real cost, the historical cost of land. And we all know that land appreciates over time. So, and not to allow our account, because if you revalue your land by appreciating it, you will definitely have unrealizable profit. You will definitely have a profit that is not cash flow profit, which will also jack up your profit in your P&L account, and it will make the account to look robust when we are talking about cost. So land is measured at any balance sheet date at historical cost. What about PPE? Property, plant and equipment. At first, they are stated at historical cost, but as time goes on, subsequent times they are being measured using either the cost model or the revaluation model, whichever that is lower. The cost model, you have to remove the depreciation from the cost of the assets, I mean the PPE, or the revaluation model. How much is it now in the market? If the revaluation amount is lower to the cost model, when you remove the depreciation or accumulated depreciation from the cost of the asset, then whichever that is lower That is the amount of money that you state in the balance sheet. So at first, PPE is stated at historical cost, but subsequently it is stated at a net book value, a net realizable value, net book value in the or carrying value in the balance sheet. So the building cost, the building is not the same thing as the land. While the land appreciates, the building depreciates. So the treatment given to PPE is also related to building. So the building too is stated at the lower of cost, historical cost, and the carrying value using the cost model, whereby you move your depreciation from the cost of the asset. Short-term investment in public stocks. Public stocks are talking about the stocks in the public liability companies. They are typically measured at fair value. So you measure them at fair value. Yes, it's not at market value, at fair value, which is their market price with changes in value reflected in the income statement. So the value that is reflected in the income statement, if it is lower to the value to the market price, then that is the value you use. You measure your what's it called? Your public stocks with. However, the approach used for short-term investment in private stocks are different. For the private stocks, it is the market value that is being used to measure the private stocks investment. But the public stock investment, we use the fair value in measuring those stocks. So that is the answer to this question. Considering the measurements we have here and the assets that we have in the question. Okay, let's move on to the preparation of balance sheet. I made mention of you writing first the owner or the person you are preparing the account for. And balance sheet, we all know that is the financial statement of an organization that shows the financial position of an organization. So and it is as at, so it's for a period of time, over not over a period of time, as I mentioned in the initial presentation. So and there are two methods of presenting balance sheet items. We have the vertical method and the tabular method. This is the tabular method where we have the left hand side and the right hand side. The left hand side has the capital and the current liabilities, while the right hand side has the fixed assets and the current asset. Fixed asset are assets that you employ into the business and that can be used for more than 1 year in the business. So there are many of them. We have land and building, equipment, plant and machinery, motor vehicle, and so on and so forth. All these assets are stated at a historical cost less depreciation to get their carrying value or their net book value, as I also explained during the measurement of assets. So looking at this question, we have equipment of 38,000 under the current asset. Current asset are assets that are expected to be circled within a short period, like inventory, like debtors, receivables, like your cash, like your prepaid expenses, like receivables, they are debtors. I've said that. And then maybe if you have money in the bank, all these things are not expected to stay too long before you get before they are liquidated or before they are turned into cash. So before they are turned into cash. So we have the inventory there being the first item according to the question that's supposed to be under current assets, then followed by debtors, but we don't have that, then cash 10,000. So the left hand side of the balance sheet gave us 63,000. And then under the capital, we have the common stock. The common stock is more or less an ordinary shareholding in an organization, in a company. So that's 19,000. Then we have retained earnings. Retained earnings also form part of the financing of a business. It forms part of financing, yes, of a business. So we have retained earnings of 15,000. Then from there, current liabilities. There are liabilities that are also expected to be settled or paid within a short period of time. So amongst them are the creditors, the overdraft, bank overdraft, loan that falls within the short period of time, short-term loans, and so on. So we have accounts payables here, and we also have notes payable. So these payables are liabilities to the organization. So we have 9,000, 20,000, and then the account balance at the end. Your balance sheet must show an accurate balances that must not have a difference before it balances. So this is just the balance sheet that we are required to prepare from this question. But if you have any question based on these things, when we meet at the proper tutorial on Friday, then we can ask your questions. Okay, let's move to the next one. It's talking about indicate whether each of the following assets and liability will be classified. So it's talking about classification of assets. Assets can be classified under long time or current assets, as liabilities too can be classified under long-term liabilities and current liabilities. Anything long time, it means that it can move from one accounting period to another accounting period. Take for instance, if you buy a generator now to be used, a plant to use for a business, you don't expect to accrue all the expenses, all the cost of that asset in one accounting period. Definitely you are going to use that asset for more than 1 year. So the cost of the asset need to be spread, whereby but you have to recognize depreciation as part of what you have actually used during that year in generating the profit, the revenue for that business. And that's why we charge depreciation into the P&L account. That is by the way anyway. So looking at this, we have expenses that are current assets and current liabilities, and we also have long-term assets and long-term liabilities. Looking at this, number one is prepaid rent. Prepayment means when you pay something in advance, like you are paying 3 years rent today. So the first year, second year, third year in accounting, when you start today, if your accounting period ends in 6 months time, it is only the 6 months that you have actually used that will be recognized in the P&L account, while the other amount of money will be classified as an asset for you. But that asset is going to be a kind of current asset because it's prepayment. So every prepaid expenses are classified as assets. We have intangible assets in accounting in balance sheet preparation like this. There are some theories said that intangible assets should be presented immediately after the non-current asset, which is the fixed asset, before the current asset. But looking at it now, there is no investment and intangible asset classification here. So we can put them the intangible asset like investment, we can put them under current assets. Yes, we can put them under current assets. Intangible like goodwill, like investment, like copyright, like patent rights, all those ones are intangible assets. Depending on the organizational policy, some of them can be classified under long-term assets, while some are classified under current assets. But most especially since they too can be used more than 1 year, I think they should be classified under the long-term assets. So intangible assets should be classified under the long-term assets. Then we have account payables. As we have account receivable, we also have account payable. Account payables are your indebtedness, your liabilities, what you ought to pay within a short period of time. So that should be classified under current liabilities, because payable is liability. Inventory, as I discussed before, and as we also prepared it initially in the balance sheet, inventories are especially the closing stocks. So inventory are assets that we expect to be converted to cash within a short period of time. So they are under current asset. Bond payable, you see, bond payable is a liability. It's what you ought to have paid, but they've not been paid. So it is under current liabilities. We have equipment is a long-term liability. You are not expected to utilize the cost of your equipment in one accounting year, that cannot be done. So equipment is classified under long-term, um current, under long-term assets, sorry. Then account receivables. So it means that we are expecting to receive that amount of money. So it's an asset to the organization, and it is an asset that fall within the short period of time. So it is classified as current asset. We have accrued liabilities. So when we have accrued liabilities, we're talking about an outstanding bills due but unpaid bills, are bills in arrears, bills that you ought to have paid but you did not pay them. They are called accrued liabilities. And as the name applies, liability, definitely they are liabilities of the organization, and accrued liabilities are classified under short period liabilities that need to be settled by the organization. So that is classified under current liability. Then we have deferred revenue. That is the revenue that ought to have been received, but they are deferred into foreseeable period, into futuristic period to receive them. So they are like receivables, but in this time round, they are revenues that are deferred in receiving. So they are assets. Anything that you're supposed to receive but you have not received it, it's an asset, and anything you're supposed to pay but you have not paid, it's a liability, and it fall within a short period of time. So it will be under classified as current asset. Then cash is classified as current asset. I hope you understand this one too. Very, very important. The classifications of the asset and liabilities in accounting is very, very important, because if you misclassify them, it will distort the judgment and the analysis by the users of the accounting information. Okay, let's move to the next slide. We have this slide. This slide is requesting us to prepare an income statement for the year ended. So income statement over a period of time, and then I'm using the vertical method because there is a single step. So I'm not using the I'm not using the this thing, the T format, but I'm using the vertical format. So we have the income. So under the income, we have sales revenue. That is the income we received from goods that we sold. That's $100,000. And then the cost of sales. That is the cost we incurred on the goods that were sold, or the materials or inventories that were actually sold, and that amounted to 78,000. I named it A and B so that you understand how we got our gross profit. And gross profit is when we deducted our cost of sales from the sales revenue. We had a gross profit of 22,000 naira. Then we have some other expenses that needs to be put into consideration before we get our net income. So such expenses include the depreciation of 11,000, other expenses of 5,000, loss on sales of equipment, that's 1,000, and marketing expenses of 8 8,000 naira. Although, okay, there's no issue, sha. There's no issue. Let's just continue that way. Then when we add everything together, we have total expenses of 25,000 naira only. And then when we match that to our gross profit, we add our net income and loss. So definitely this one led to loss and not a profit. So we had a lot of $3,000 from this income statement that is prepared based on this information given for the year ended 31st December 2026. That's a year to come. The year is supposed to be a past year, but notwithstanding, this is just a test, and then it's just a kind of a specimen question to just practice and learn how to manipulate these figures to get your result. Okay, can we move to the next slide now? All right. So match each measure of income with its description. So we have income like gross profit, net income, operating income, and pre-tax income. What is the meaning of all this? You are also giving some options for the meaning. All revenue minus expenses. When we are talking about all revenue minus expenses, we are discussing about operating As talking about net income, yes, all revenue minus expenses is talking about net income. When you remove your you remove all revenue from expenses. When you remove expenses from all the revenue, you get your net income. Then we have profit before accounting for income tax. That's a PBT, profit before tax. So that's a pre-tax income. That's why I match it with B. It's a pre-tax income. It's an income that you realized or calculated before removing tax. And when you remove tax, it become part. It becomes profit after tax or post-tax income. So that is what is meant by income before accounting for income taxes. The pre-tax, as I put B there, profit related to operating activities of a company. That is operating income. So we are talking about the profit related to operating activities of the company. So we are talking about the operating income, and then profit directly related to the key cost needed to generate those revenues. So we are talking about the gross profit. However, you talk about the cost of sales match with the sales, the revenue. The cost of a revenue match with the revenue to get your gross profit without considering other expenses. So the other expenses are removed from that gross profit to now get your net income. All right, so that is just the simple explanation of this slide. Let's move to the next slide. Match each business activity with its description. Okay, in the cash flow statement, there are three headings that are very, very important. We have the financing, the investment, and the operating. You have the financing, the investment, and the operating. You have the financing, investing, and operating activities under the business activities considered under the cash flow statement. So what are financing expenses? See, they involve, but no. The financing expenses involve how you finance your business. So you finance your business with either loans or capital from the owners, and that is B. So that apportionment or classification there, sorry, is wrong, and I don't think I can go back now to correct, but just listen to me very well. The transaction related to revenue and expense, the transaction with lenders and owners are classified under financing, while the transaction related to revenue and expenditures are, are classified under operating activities, while the transaction that involve purchase and sales of productive assets are adequately put under investing. So the company or the business invests in assets to to produce or to manage to run the business. That's investment. That's investing activities. And we have financing activities that have to do with the way, where do you get money from to finance your business? If you get loans, you get introduce capital, additional capital, and other things like that. They are classified under financing, and that's why B comes to 1, while C comes to 2. Yes, C comes to 2, B comes to 1, 3 remains at A. Okay, let's move to the next slide. Time is somehow going. Okay, under net income and comprehensive income, this place, the next question is a kind of classifying information that has to do with income statement and statement of comprehensive income. There are two different things. Let me read this. A statement of comprehensive income is a financial report that summarizes a company's financial performance over a specific period, including both net income from the income statement and other comprehensive income. When we are talking about income statement, the income statement is used to prepare the to represent the transaction that has to do with normal business transaction, like buying, selling, working out depreciation on assets and other things like that, making provisions for bad debt. So like that. All those ones are normal business transaction. But the OCI, after getting your net profit, there is need in company's account to prepare the OCI. So the OCI includes items like unrealized gains and losses on investment and disposal of assets. In the real course of business, businesses are not expected to dispose their fixed assets or their investment. They're supposed to be generating returns on them and using them to run the business. But when that happens, it's not a normal business transaction stuff. So they need to be reported to the OCI. Yes, they are being reported in the ACI. Then we have foreign currency transactions. If you have a branch now in a foreign land, and the parent company is here, and you want to merge, you want to prepare kind of a financial account to show for the parent under subsidiary accounts and then parent accounts. When you are bringing that money into this place, Nigeria, you have to convert it from whichever country's currency to naira. In that case, there may be loss and there may be profit. That is not true normal business transaction. So they are reported under OCI. We have certain adjustment related to pensions and hedging activities, options activities, deliverables activities, which are not included in the calculation of net income. So those things are not included in the net calculation of net income, but they are also included in the calculation of OCI. Because if they are not included, the account will not show its true fair and view position. Okay, we have essentially it provides a more complete picture of a company's financial health by including items that impart equity but not part of the traditional net income. So the those transactions that I just mentioned, they have effect on the equity and the capital of the organization, but they are not under the traditional course of business as you can get that. Okay, so let's move to the question. We have cost of goods sold. The cost of goods sold, I classify it under income statement because we look at the income and match it with the sales to get our net profit, and we are considering income statement here. So the income statement comprises the trading account and the profit and loss account. So that's why I use I to represent income statement and S to represent statement of comprehensive income. We have gains on sales of equipment. I've just explained that. So it is not a normal course of business. So it goes to the SOCI. Then marketing expenses. That's like advertisement expenses, normal business expenses, income statement, foreign currency adjustment. I've just explained that too. It should not be under the income statement, but under the comprehensive statement of comprehensive income. Comprehensive income, yes, that's where foreign currency adjustment is supposed to be reported. And then talk about depreciation expenses. It is normally reported in the income statement. Interest expenses, income statement. Pension plans, gains, losses, statement of income, comprehensive income. Income from discontinued operation. This is not the normal stuff, so it is statement of then we have other income and expenses. Since they are other income and expenses not specified, they should be reported under the income statement. Then we also have the unrealized gains and losses in deliverables. I've just explained that before too. It is not a normal, what is it called? It's not a normal course of business as in day-to-day activities of a business. So we report it under the statement of comprehensive income. Okay, let's move to the last slide for today. Thank you so much. As I said before, my name is Wona Oluwashino, and I really appreciate you for your time. And please don't forget to ask question or to jot down your questions that you ask when we meet 7 to 9 p.m. on Friday. This method, I think it will make us to cover more if you have listened to this, so that it will also reduce our time when we meet online on Friday. Pastor Dr. Ibrahim will get back to you people on the media. We are going to the method where we are going to meet and then the link. look forward for us to meet. Thank you so much, and God bless you all in Jesus' name.